So next up, we have Wallbridge, a gold exploration development company with projects in Quebec, Canada. And here we have CEO Brian Penny.
Where's the...
Sorry, 1 second. Keith must have just... Oh, there it is. Okay.
Thank you. Thank you, and thanks to Kai and the team for organizing a great conference. It's the first time we've been here, but we're definitely coming back, and you're establishing something special here. Wallbridge is a development company. We're focused on one asset. We're focused in the northern Abitibi. We have 2 discoveries in our 1 property position. One is Fenelon, which has a resource of 3.5 million ounces. The second one is Martiniere, which has a resource of 750,000 ounces. They're located about 30 kilometers apart, and to the west, about 70 kilometers from Fenelon, is the Detour Lake Gold Mine, Canada's largest gold mine. As you can see, our property position, 97 kilometers of strike on the same trend as Detour. We own all the properties in blue. The gray ones we're either earning into, or in the case of Detour East, Agnico is earning into. They have to spend about $2.7 million. Then it's a 50-50 ownership and a joint venture is formed. Our share structure at the end of last quarter, yes, we do have 1.1 billion shares outstanding. Wallbridge has been around for about 25 years. Started off as a base metal explorer in the Sudbury Basin, converted to gold about 6 years ago, and right now we have about $15 million in the bank. And Quebec is one of the best jurisdictions to explore in, because for every dollar of qualified exploration, we get a tax refund when we file our tax return of 37.5 cents for every dollar spent. So we filed our tax returns early this year, and we're expecting that refund to come in the next month or 2, and it's almost $4 million. We do have 3 larger shareholders. Eric Sprott owns 15% of the company. Agnico Eagle, which inherited the position when they acquired Kirkland Lake Gold, owns 9.9%, and they've participated in all the financings to maintain the pro rata share and are very supportive. And a longtime shareholder, Willing Day Construction out of Sudbury, when we were a base metal producer, owns about 5%. Our board, my history is I was the first CFO of Kinross from 1993 to 2004. After I left Kinross, I joined forces with Randall Oliphant, the former CEO of Barrick. We took control of a junior called Western Goldfields. It was shut down. We financed it. We got the permits extended, and we put it into commercial production. And then a couple of years later, merged it into New Gold, where I became the CFO of New Gold for about 11 years. So I've seen projects, I've been in projects, and I think I have a lot to add to this. Mark Peterson was our VP of X at New Gold. When our previous VP of X at Tilapentec left us to go to work for Rio Tinto, he was the first guy I called. He was available. He's an economic geologist. It's just not connecting dots here. It's really digging in and understanding the geology and finding the best quality ounces here. We're focused on ESG. We have 3 First Nations partners. 2 are from the Cree community, which we have signed pre-development agreements. 1 is from the Algonquin community, which we're working on a development agreement that will be signed later this year. We focus on buying as much from the communities around us as humanly possible. 25% of our workforce is sourced from the First Nations communities. We do have a process where we tender contracts, and if the contract fits them, they can tender on it. And focused on health, safety, focused on ethical performance. I don't have enough time to go through the 25-year history of the company, and I've only been with the company for 6 years, so I couldn't remember it anyhow. Let's talk about what happened recently. In 2016, Wallbridge invested in Fenelon. Fenelon, our initial investment was a 10.5 square kilometer property, which is where all the resources are today. In 2019, we had our major discovery, was Area 51. 51 is the 51st hole. and later on we added Tabasco Cayenne, and in between is known as the contact zone. We liked what we saw so much that we did a capital markets transaction and acquired 100% of Balmoral through a business combination. The historical nickel assets were sold, and most recently, at the end of March, we published a new MRE and a new preliminary economic study. The results of the PEA. This was done at $2,200 gold. Why we used $2,200 gold? That was the analyst consensus price at the time. I will talk about sensitivities a little later on, and I'll have to watch my time so I make sure I get to it. But you can see the numbers. 107,000 ounces a year. In the first 5 years, it's 127,000 ounces a year. All these dollars in Canadian dollars except the unit costs. Good cash flow, manageable startup capital, and an IRR of 21%, based on $2,200 gold, which is 1,000 less than today. At $3,000 gold, the after-tax IRR goes to $1.4 billion, and the internal rate of return is 34%. So a project definitely worth pursuing, and how do we get to the next step? When we built the PE, went to first principles. Here's a schematic of, it shows all the stopes that will be mined during the mine life. The gray open pit portion, where the word open pit is the underground infrastructure that's in place. We did a bulk sample in 2018 and 2019, built some underground infrastructure. It's flooded now. It'll have to be dewatered, but it's something to build upon. It will be a ramp mine. 3,000 tons a day, we can effectively get up the ramp to feed that mill. We're focusing on risk. We're focused on the tailings will be dry stacked. Dry stacked is the right way to go. We're in the Hudson's Bay lowlands. There's an unconsolidated glacial fill around us. So we have to be cognizant of that and design things which is best. It's best for the environment, it's best for our permitting, and it's best for our First Nations partners. The plan is 2 years to build it, 15 years mining from a ramp, and then the last 2 years, there's some open pitable resources around where the portal is, the entrance to the underground, that we will mine at the end of the mine life. Just because if we tried to do it earlier, we could destroy the infrastructure below it. So, we'll keep that for the end. One of the things we have to further investigate is this blue line, the one going, left to right on the bottom, is the James Bay hydroelectric transmission line that comes from the huge James Bay power plant down into southern Quebec. Currently, industrial users pay 5.5 cents a kilowatt hour. The budget includes a 30-kilometer power line up to the site. We have applied for an allocation. That will be finalized once we have our feasibility study done, which, pre-feas first, feasibility second. So we're in the queue, we're talking. And then with that, we can focus on electrifying as much underground, because to help with your financing, the smallest carbon footprint you generate, the better off you are. Again, focusing on risk. The layout, it's it's a small footprint. We're talking about 3,000 tons a day with a dry stack tailings. The entrance to the underground is inside what's labeled as the Gabbro pit. And because we're a remote environment, we do have a camp. Our workers are 14 days in, 14 days out. So, we have to add all those white boxes to the camp to provide the capacity for commercial production. Historically, we've done MET testing. The MET testing indicates a 96% recovery. The plant is very simple, gravity, CIL, so it's a simple flow sheet, and the crusher will be on surface because we're carrying everything up the ramp in 50-ton trucks. Here's the annual grade and production numbers. As you can see, in the first 5 years, it averages 127,000 ounces, which helps us get a very quick payback. At $2,200 gold, the payback is 4 years. At $3,000 gold, the payback is 2.5 years. In this mine plan, this PEA mine plan, we mine out a little more than half of the resource. So it provides, as we get into the pre-fees and our infill drilling, if we lose some ounces, it's not stressful. And generally, as an industry average, as you increase the confidence of your drilling, you may move inferred 60% into indicated. And so if that happens, we've got lots of coverage here. 16-year mine life with a 4-year payback at $2,200 gold helps with the financing, because there's enough tail on it that, you know, project lenders will take a look at it, and if there is, you know, a speed bump, we'll be able to easily work through it. Here's the annual after-tax cash flow. Last 2 years, it's, you know, a small open pit, so that's why it falls down so much. And here's the sensitivity table to various gold prices. The firms that were involved in the PEA were, you know, we brought in a Mauro Basutti. He was the resource and reserve guy at New Gold when I was there. He put together the resource estimates and the section of the new technical report that was filed at the end of March. Innovexplo did all the underground mine work, electricity, you know, dewatering, etc. We brought in G Mining Services because they're one of the best to look at metallurgy, mill design, etc. BBA did the surface infrastructure. And I brought a group out of Sudbury called Mayhew Performance too, because I'm a CPA by trade. I'm not a technical guy. So I brought them in we built everything from scratch, and just sort of a third-party review to check. They have a huge database of, you know, producers in the area and what their unit costs are, just to double check to make sure we're in the right ballpark. And it confirmed it. And Pierre Rock is now the COO of Discovery Silver. And so, you know, we had a really good team looking at this. Our second project is Martiniere. Historically, Fenelon has about 500,000 meters of drilling on it. It goes back to the 80s. Martiniere is about 100,000, maybe 150,000. Our focus this year, because we're at a stage where we've got a study on Fenelon. The team is working on what engineering studies do we need to do to take it to a pre-feasibility, and what infill drilling we need to do to improve our confidence to get to a pre-feasibility. So that work is ongoing, and, you know, we can't go pens down. And so what we're looking at here is, our goal this year is to primarily explore Martiniere. Our drilling is in 2 phases, 9,000 in the first half of the year, 8,000 in the second half of the year. We will have news flow later this month, and then after phase 1 is done, because we shut down for 4 weeks to catch up on assays and make sure we're doing things right. And then another update after the program, probably late June, early July, and then 2 updates in the fall. As I mentioned, we were discussing a pre-development agreement with our Algonquin partners. You know, there's another source of news flow going forward. And then obviously, once we figure out the timelines and the costs, that will be you know, announced when we put our budget together for next year. So to summarize it, nice mine life, 16 years, a growing resource. It's open at depth in all directions. At Fenelon, there is 1 drill hole that is 10 grams over 15 meters down about 1.5 kilometers, 1.2 to 1.5 kilometers. So lots of potential. It's in the Abitibi. Great recovery. With Martiniere, we had some met testing done. The recovery is 86%. So we need to define, you know, a bigger resource to make sense out of that one. But again, it was a first met test, and we got additional work to do. It's early stages. The best location in the world to have a mine in the province of Quebec, very supportive of exploration. You know, they helped us fund a road redevelopment. The government paid $6.5 million. We paid $1.5 million over the last few years. Very supportive, great access to labor, and great relations with our First Nations partner. And, you know, focused on the environment, focusing on a safe workforce. It's been 6 years since we had a lost time accident, and we're advancing this project. We think we've got an approach now that's the best foot forward, focusing on the highest margin ounces in the startup of this operation. So with that, I will open up for questions, or you're going to open up for questions.
Yes, if there's any questions.
Yes.
Your production costs, they are seemingly relatively low. Are they inclusive fees and taxes?
No, it doesn't include taxes. All-in sustaining costs. How much is their taxes? The tax rate's about 30%. Yeah. But you can see the cash flow is after-tax cash flow, so it's very attractive. Yeah. But we follow the Gold Institute standard of, cash costs and all-in sustaining costs. And when I was at New Gold, I was on the World Gold Council and was in the room when we developed those standards. So.
Is Eric brought he bought your shares when?
Eric bought the shares probably between 7 and 5 years ago. So he's a long-term shareholder. He hasn't participated in recent financing, so he's been diluted a little bit, whereas Agnico participates in all our financings to maintain their pro rata share. Yeah.
Any comments on the current share price? Because it was, some years ago, it was 1.2 or something. Now it's
Well,
lower.
just so you understand the history, it started off when we did the bulk sample. It was in a gabbro. The grade of the bulk sample was 18 grams. At that point in time, the thought from various investors and others was that this was a small, high-grade, very cash flow friendly mine. The gabbro was very limited. It was very podular, and as we drilled further, we found Area 51 and other deposits. So as we learned more of where this company could go forward, and this is the best option. We can always expand it in the future, being that the mine plan mines out 52% of the resources as we know it today. So there's room for expansion in the future. Let's start off slow. Let's figure out how quickly we can get this into production.
Okay, and with that, we are going to be taking a break here for the next 10 minutes. And thank you, Brian. Yes.